I frankly, I think Gaurav captured it really well. I don't have much to add. I think in some sense, at the end of the day, the fundamentals of business hasn't changed, right? So I don't think there is a drastic change in overall metrics that you would look at. Hasn't changed. I think the only thing is that some interaction aspects have changed. For example, in last 2 years, before COVID, we would have never thought that we would have invested in a company without meeting the founders, and we have done that largely through Zoom calls and all. So I think this whole remote kind of thing has drastically kind of accelerated. In general, I think one of the positive aspect of COVID has been this whole digital adoption and digital transformation journey of enterprises have accelerated. So when just COVID hit, we were really worried that what is going to happen to the startup industry, and because this is the most riskiest asset class, it might affect the venture capital as a business. And interestingly, I think the effect was entirely opposite, and primarily because people, instead of looking for safe havens, and they did, but at the same time they started looking for long-term bets, but also bets which they see that and because benefit from this whole this is the most riskiest. And we saw a lot of businesses it might affect the venture capital as which allows them to interestingly to work remotely, because that was I think the kind of this whole entirely opposite. Adopting technology is primarily because urgent people, instead of looking for safe havens, and they did, but at the same time they were started looking for long-term bets, which we are going to see next 5 years is that and because from this is the most riskiest. And we saw a lot of businesses that kind of it might affect the venture capital as which allows them to interestingly to work remotely. I think the effect of this whole entirely opposite. Adopting technology is primarily because urgent people, instead of looking for safe havens, and they did, but at the same time they were started looking for long-term bets, which also bets next 5 years is that and because and I think next 5 years we are the most riskiest businesses kind of it might affect the venture capital as which allows them to interestingly to work very strong. I think the kind of this whole entirely opposite. Adopting technology. So I think that would open up opportunities for looking for safe havens, and that is already happening. The thing which has happened is the SME side of business, but I think we are going to see that in the next 5 years we are for slightly so that I think that as a founder should look out for very strong adopting technology. So I think that is
addition to that, I would also want to know how significant are the projections that are projected by the founders in the business. So, how important are those to value investors, and
I think, to be very frank, it has little meaning beyond kind of understanding two aspects. One is that broader aspirations of the founder, to gauge that how big they want to become. If someone comes to us and say that, hey, we want to become $2 million company 5 years down the line, that it kind of indicates that they are not aspiring enough to fit in from the VC context perspective, right? So I think we also want to gauge that how aspirational founder is, but at the same time, if they put unrealistic numbers, which kind of indicates that the founders really haven't thought through the space really well, and their ability to execute, and these numbers have been picked from thin ice without having enough thinking about it, right? So I think beyond that, the reality is, particularly for early stage founders, have hardly any visibility beyond 12 to 18 to 24 months. So I think instead of looking at a 5-year projections, we really like to focus on what they are going to do in next 18 to 24 months. And that is where we like to spend our time to kind of discuss with the founders in terms of what looks achievable and what could be delivered. It is also very important from VC's context perspective, because we are investing for next 24 months. And if the company wants to continue their growth momentum, they would be very soon looking for next round of capital. So we like to see our capital should be good enough for company to achieve a milestone that would make them attractive to next stage of investor, for example prime ventures, right? I think so we work with funds who invest in next stage and gauge their inputs in terms of what is that they would be looking in companies to invest in, and we work with the founders to make sure they achieve that milestone with our capital coming in, right? So I think that is one thing that we focus on in projections perspective, but projections which hardly make any sense. So focus on kind of next 18 to 24 months as a projections. Try to relatively detail it out. I said relatively. I didn't mean to say that a very, very thorough projections, because it is going to evolve. But don't spend a lot of time in defining 5 to 10 years projections and waste your efforts on that.
Right. So, Gaurav, so what is your take on that? Do you concur with Saurabh sir's ideas?
I concur 100% with what Saurabh said, right? So, I mean, projections at early stage doesn't make sense too much beyond what Saurabh already covered, right? One is look at the aspiration of the team and the founder, how big can they think? And in thinking big, are they being rational or realistic, or are they being irrational? That is one. Second, of course, we do try to see whatever money that we are going to put in, say 2.5, 3 million, will it take them to the next milestone? And that milestone typically happens in the next 18 to 24 months, right? So we do look at financial models, the stage that we come in, but again, that is not a key decision-making factor. That is just to get an idea or the sense of how quickly can the business grow, how much money would be needed for that, right? And I can say it of all the companies that we have invested in, we have looked at the financial models. And if I look at those financial models 18, 24 months down the line, none of them have worked out as it was planned, right? In some cases, it has grown at like double, triple the pace. In some cases, they have been like 40, 50% of what they projected, right? So financial models are just a good way of getting a sense of where the business can go, right? It is absolutely not something that is like a stone on like a line on a stone that can't be changed, right? It changes, and it changes 100% of the time, right? Anybody who has built a business model for the next 5 years at seed stage, I'm sure things would have been very different when they look at it 5 years down the line, right? So it is important just to gauge the aspiration of the founder. Will our funding take them to the next milestone? And of course, to validate some of the assumptions, right? Because when you're building a financial model, you take a lot of assumptions because there are a lot of unknowns. Hence, you take a lot of assumptions. So it also gives us a sense how rational or irrational these assumptions are, right? And suppose you assume something, and if we look at that financial model 6 months down the line, it also gives us a sense where the assumptions valid or not, right? And if we have to change the way we think about some of those unknowns.
Right. Gaurav, sir, I also wanted to understand this one thing. Do you work with companies in your portfolio to, sort of pivot from their ideas for, what are the factors that would lead for a company to pivot? And as investors, do you encourage your startups to pivot? And what are the factors for which you would, sort of encourage them to pivot from their ideas?
Yeah, so see, we come in at early stage, right? And Saurabh comes in even earlier, right? So we do invest, as I said, on the team and the market, right? And broadly what the team wants to do, the problem that they want to go after. While the problem statement may remain the same, the way you are trying to solve that problem will change based on the learnings that you've had once you start executing. So in that case, we do encourage our companies to pivot if things are not working well, or if they see a better opportunity, right? For instance, we invested in a gaming company which was building, for instance, a social network for gamers, right? And then we saw a lot of action happening in the Web3 side of gaming, play to earn and other models came up. And they saw that opportunity was even larger, emerging, there's low competition, still early days for the market. And the team was well poised to move in that direction. So they pivoted in that direction, right? So we do encourage our companies to pivot, provided what they're doing, they see a better opportunity somewhere else in a related space. So it can't be that you're building, say, a gaming company and tomorrow you start building a B2B cross-border commerce company, right? In terms of pivot. It has to be in a related space where the team's competencies are aligned in that space. They're able to build in that space. There's nothing wrong in pivoting at early stage, and that happens multiple times.
Right. I think Saurabh, a similar question, and also an extension to that, I would like to know how often does this happen that founders need to pivot from their ideas into like sort of different markets or different domains or something like that?
Yeah, I think this becomes more common in kind of pre-seed companies, where companies are kind of piloting with different ideas, and they realize that the markets are not responding really well, and things like that, and that in those cases founders do pivot. I think the underlying kind of messaging is in early stages, fail fast, right? Be willing to experiment, and if the experiment doesn't gives the right signal, be willing to give up that idea and get into the next one, without being married to that idea or solution, right? Because I think one of the things that mistake that founders make is that they get married to a solution and an idea, and they should be more married to what problem they are solving and whose problem they are solving. And I think there is a common kind of saying, which I think if the first time founders kind of understand it, that would make a huge difference. And the saying is that the first time founders start with a problem or a solution. The second time founders start with markets. And I think that is a very important thing that to keep in mind, is that don't get hung up on a specific idea or a solution, but start with right problem statements in a markets that are large enough, right? So and I think going back on this aspect of pivot, yes, for sure. I think if you are not seeing the right kind of metrics that are coming from the customers, be willing to give up and move on to the next one, right? And we see some of our portfolio companies who are doing that, who are doing this very, very actively. I can't talk about these companies because they are still in kind of transition phase of doing so, but this is a very common activity, and something as a founder I would encourage you to be open to that, because many a times a lot of founders who start with something, even the most successful ones, and when you start going deep into their journey, you would realize that what they started with and what they are into, right? Even like Ola, I remember that they started with something in hotel management industry, and they ended up being in travel space. So be willing to pivot early in the journey.
So, like you said, that the market size is very important while you're investing, right? So I wanted to know if there are startups which work in very niche fields, right? Which have like a very small market. So how do you deal with startups like that? If say there's a startup which has an excellent idea, but the market size is really small and it's a very niche field. So what is your take at that point of time?
Yeah, is this Gaurav or is this for me?
I think either one of you, maybe Saurabh, so you could start.
Okay, yeah, absolutely. In fact, one of the interesting thing, and this is kind of a question that get asked in several times, and that's an important one, right? People, I think at one end, people say that, hey, how big is enough is your markets? But at the same time, people ask that, okay, how focused you are in terms of solving someone's problem. And I think my sense is, and I'm sure, I think there could be different perspective to this, is that it's always a good idea to start with a very narrow problem, to make sure that you pick a very small segment of the user base, make sure that you solve their problem really, really well when you begin with, and make sure that you delight that segment of the user with the solution that you are bringing to the table. But at the same time, be clear that your long-term story is not hinged to that customer base. You know that your solution could expand into adjacencies. Your solution operates in a far more larger opportunity landscape, where you might have a wiggle room to expand and keep on growing into this, right? I remember, like if I'm not wrong, Uber kind of started with focus on luxury kind of rentals, right? But they kind of expanded into mass kind of travel segment, right? So I think in my mind, it's always good idea to solve a far more niche problem to start with, because if you are a solution for everyone, you are a solution for no one, right? So I think be clear with that, but at the same time, don't lose focus on the bigger picture.
Right. That makes sense, sir. Gaurav, sir, similar question to you, and also an extension to that. Like, so there are founders coming up in niche fields, and what is your take on that? And along with that, there are, I believe, certain sectors in India which are now like very crowded, say, edtech or SaaS. So in those sectors, how are you, identifying those key solutions which are like which you believe would do extremely well in the future? So,
got it. Okay. So see, touching a little bit about the market size thing, right? So market size, of course, is important, but again, markets keep expanding and it does change, right? Airbnb, for example, started off as air bed and breakfast, where they're leasing out air beds, but they got into like home rentals and so on. So there, it is important for the founders to keep an open eye and see where else can they expand if the initial market is too small, right? Starting a niche problem, again, there's nothing wrong in starting with a niche problem, right? See, the thing is, when people think of doing businesses and market size, VCs look at large markets because there you can build large companies. There we can build large companies, and VCs can make good return on their investments. I'm talking more from an investment lens, right? There's nothing wrong in building for a niche category for an entrepreneur. The only thing is you may not need to raise VC money, right? Which is a good thing to do if you're building in a small market, doing it all by yourself in a bootstrap manner, right? But the point that I always make to entrepreneurs is if you're getting into entrepreneurship, think of like building something big. And if that's the case, you need to go out to large markets, right? However, as I said before, there's nothing wrong in building a niche product for a niche market, right? As long as you're able to build a successful, profitable business, sustainable business in that category, right? So that talks about the niche market or the size of the market, the way you should look at it. The other question, sorry, Tanya, if you could repeat the second part of the question.
Actually, the second question was that there are certain sectors in India which are highly crowded now, right? Like edtech and SaaS and stuff like that.
Yeah, so in crowded sectors, see, it is difficult to make bets in crowded sectors, and that too when you have some established, well-funded players. I know edtech, if you look at edtech, like there are 3 or 4 unicorns in edtech, which have good amount of money to build whatever they want. But still, there are some white spaces within the edtech market as well, right? Recently, there's a company called PhysicsWala, which is all bootstrap. They raised funding, large amount of funding at a very good valuation, right? So even in crowded markets, the way we look at, we call it red ocean. In red ocean, you do have white spots, right? Where there is an unsolved problem, where you can still attack that problem, get into that. That problem may seem niche, but if you're able to acquire users solving that niche problem, there is a chance that you can expand into other product verticals, other solutions for the same set of user, and grow your market from there and kind of beat out the competition, right? But in crowded market, it is difficult to make investments, right? And that too, when you have a very well-funded player out there doing something similar to what you're doing. But there are definitely niches which you can attack and get an entry into the market, use your product as an entry product, the niche product as an entry product, and then expand into other areas in the same market. Right now, EdTech, of course, is crowded in India right now. There are different business models, but there are still white spaces in EdTech as well. SaaS, you mentioned, but SaaS, I would still say, is not very crowded in India, both domestic and international. SaaS is a large market, and Saurabh can share more about it. But SaaS is definitely not crowded. If you're building something in SaaS, I think it is the right time to build. Whether you're building for India or for globe, I think SaaS is the right space to be. But yeah, I mean, see, when you're building, I'll add another lens here, right? So when you're building startup, right, at early stage, there are multiple risks that you are playing against, right? It is ability to build a team, ability to acquire a customer, ability to raise funds, and so on, right? So getting into competitive market is another risk that you are trying to fight against, right? So it is always better to reduce the number of risks or unknowns that you're going against, and hence it is prudent not to get into a competitive market unless and until you have like a really unique insight which your competitors may not have.
So, Gaurav sir, I would like to ask you one small thing, and even Saurabh sir could add on to that. So right now in the startup ecosystem, or if I look at aspiring entrepreneurs, raising funds has become like a very glamorous thing to do, right? So everybody's like looking for investments, like seeking funds and stuff like that. So are there instances where you come across founders and you're just like, dude, you don't need fund right now, so you don't require that? So have there been instances with you while you were hearing somebody's pitch and you believed that that person did not actually require funding.
True, that happens a lot of times, right? And I always often tell this to entrepreneurs that when you're just getting started up, fundraising is not the first problem that you need to solve. And a lot of founders make that mistake. When they think of starting up, the first problem that they start solving is fundraising. No, that is not the first problem that you need to solve. You need to figure out your MVP, you need to figure out your early customers, get customer feedback, build and iterate on the product, right? Fundraising is, of course, you need to know why you need to raise funds, right? A lot of times you talk to people and they have no idea why they want to raise funds. They're raising funds because everybody in the startup ecosystem is raising. And that's how you start your journey. No, that's not right. You start your journey by building a initial product, doing initial bit of market research, selling a product to initial set of customers, getting feedback from them and so on, right? So just think of it, think of the right time when you want to raise fund, think of why you want to raise fund, rather than just thinking of raising funds the moment you think of starting up.
Right. Saurabh, sir, would you like to say?
I completely agree. I think irrespective of the glamour around it, the reality is that a very small percentage of founders are able to raise capital. Irrespective of kind of sudden increase in capital raise, still a lot of founders are not able to raise capital, which we don't hear about because they don't come to the news. That is one thing. The second thing, because of COVID, what has happened, and not because of COVID, because of the sudden increase in capital raise, even founders who have been kind of so far have been bootstrapped, have been running their business well, they have been kind of started sitting in this bandwagon that, hey, it seems like everyone is raising capital and we need to also raise capital. And we have come across several founders who are doing well. They are growing at a good pace. They are profitable and they have come to us for raising capital. And we have advised them that why you even want to raise capital. One is that you are not in the space which might get the excitement from VCs because probably it's a narrow market and so on and so forth. But you can grow your business in a steady fashion, in a fairly bootstrap fashion. So why to dilute your own equity? See, capital raise is also a double-edged sword. You are actually giving up control of your business, and an outsider start pushing you in growing your business, which may be out of your comfort zone, right? So it should be a conscious decision for a founder that why they need to bring a outside partner, because you are not only bringing capital on board, you are also bringing a partner on board with whom you might realize that your ethos doesn't match, right? And it could be a disaster for you, right? At the end of the day, I think you need to be clear that you are really on for a high growth journey, which VCs are interested in. And if you are coming with a very strong mindset for growth, is when you should think of partnering with VC.
Right. So I think one mistake that we can all avoid, like all the entrepreneurs can avoid, is raising funds at the wrong time or for the wrong purposes. I think in extension to that, I would really like Gaurav sir to tell us what are the very common mistakes that you see founders making, either while pitching or while building their products. What are those common mistakes that we can all avoid?
Yeah, there are, depends on the type of founder, the kind of business model, etc. It's subjective. But there are a few common things that people do, right? So one is, the most common thing that I've seen people do is not being close to your customers at early stage, right? A lot of times we see people come up with an idea and start building without doing enough market research, without talking to the actual customers whom they're building for, right? So that is one. And you need to do that in the early days till you have a scalable product, till you start growing organically and so on, right? So you need to be very close to your customers. That is one thing. The second thing is, founders are very close to the business, right? So, the business in and out. But at times what happens is, when you pitch to investors are not doing that thing day in, day out, right? So as investors, you look at multiple businesses in different sectors, right? So of course, you'll not have that deep understanding that a founder who is building in the trenches would have, right? So founders at times have difficulty in explaining the problem statement or the customer or the solution in the right way, right? Because for them, a lot of things are obvious, which may not be obvious to an investor, right? So that's the other thing we see, that gap, right? Founders need to both zoom in when they're executing. Of course, they need to be closer to the business, but when they're thinking long-term or raising funds, they need to think from a 10,000 feet level rather than being very close to the ground, right? So that's the other thing that we see missing, right? That you're too close to the business to be able to think long-term or to be able to think from a neutral point of view, right? The third thing that we have seen, again, this happens at early stage with is founders. This is a little bit to do with the cap table side of things. There is founders raise money from a lot of angels, a lot of friends and families, and that kind of dilutes the cap table or makes the cap table complex. And that is a bit of challenge for an institutional fund coming in at a later stage. So you have to do that cleanup, right? The other area which we see, again, at our stage at least, founders do overlook the compliance and the finance and the accounting bit, right? Because for them, building business is the core, and of course, that is the right thing to do. But you need to, as soon as your business starts generating some revenue, once you start getting some users, you need to put somebody to look after the compliance and the financial aspect of things. Because we've seen in a lot of cases where we have agreed to invest in a company, but it took 3 months for us to wire the money because the cleaning of the books took 3 months, right? Because founders were bootstrapped, it was running well, but there's nobody to look after finances and compliance and so on, right? So those are things which get overlooked, and hence you need to focus on them at the right time, right? So these are some of the common mistakes that we have seen, and of course there are many, but these are some of the things which are like top of my mind.
I think Saurabh, you could add on to that, and also I just wanted to add one small thing that, Gaurav sir, Saurabh sir, and we all come from engineering backgrounds, and so do a lot of entrepreneurs. So is there anything specific towards people, tech people or engineering people who make some, very specific mistakes? So if you could just point those out as well.
I would expand on that, and I think my broader kind of perspective, and I think Gaurav kind of expanded it really well. The broader thesis, particularly for early stage founders, is this customer centricity, and I think this links a little bit to the engineering aspect of students. Is that, and let me bring some granularities to it. I see a lot of early stage founders who are kind of starting their journey or kind of come up with an idea. They come to VCs and validate their idea, and that is the biggest mistake. See, VCs are not sectoral experts. We are investors, and we bring horizontal expertise in general, but not very specific kind of sector or specific customer oriented validation to it. I think the validation of the problem should be done at a customer end and not at a VC end, right? That is one. The second is that a lot of founders get excited with this startup as an industry. There are so many events, conferences that are happening around startups. There are awards being given and things like that. See, don't get swayed by the excitement and the craziness around it. I think go to conferences where your customers are. Try to pick up those conferences rather than kind of joining these conferences with a view that you will be part of this startup bandwagon, right? That is one. The third piece is that spend a lot of time, if you are not necessarily coming from that sectoral background and you don't have access to those customers, I would say kind of talk to hundreds of customers as much as possible. Bring some unique insights to the table. I think that is what investors are actually digging for, right? I think when you are in early stage founders, instead of saying that I'm going to build this product, I'm going to build these feature sets, I'm going to bring AI angle to it, I'm going to bring blockchain angle to it, I think all of that is secondary. I think firstly, if you can kind of make investors excited about the unique insights that you are able to bring by talking to prospects and bring some unique insights to the table, which leads to a problem statement and ultimately a solution that you want to bring to the table. So I think that is my third comment. And I think now that you have asked for engineering side of things, I think engineers by default get excited about building, right? And they say, okay, let's start coding. And in fact, in today's world, because of such a great kind of no-code technologies that are available out there, you could actually kind of get your at least the MVP side out. Yes, I think as you move forward, you would definitely need technology resources to build your product, but to get your MVP out, in 80% of the cases, you could leverage a lot of no-code technologies to get your basic product out, which you can showcase to your customers, right? So don't start coding from day one. Actually, start with the customers and start following them to begin your journey.
Right, that makes sense, sir. Like absolutely insightful. So I think coming to the end, I would like to ask Gaurav sir to, what would be your advice for early stage startup founders looking to raise capital?
So the advice is pretty straightforward. Start by talking to your customers early, right? Get some unique insights. So the point that Saurabh spoke about, unique insight, that is what we look for, because suppose they're building something in the edtech space right now. Things may look very obvious to a layman, to an investor, to a end customer, to a startup founder, right? But what differentiates a startup founder from an investor or anybody else is their unique insight about the space, about the customer, about the way they're going to build that product, right? So focus a lot more on what you know about that business that will help you succeed in that business, what are competitors, what others don't know. And that'll only come when you start talking to your customers, right? And start building, right? So that is one thing. Second thing is, when you're thinking of raising funds, just think why you want to raise funds. Just don't blindly go into the market to raise funds. Just think why you want to raise funds, whether it is to build the team, whether it is to build the product, whether it is to acquire customers, and have a timeline in mind. If you're looking to raise say $500,000 or $1 million, what is it that you want to achieve from that money? That is very important for investors. To know that if you're raising $1 million, you're going to build a team, you're going to build the product, you're going to acquire customers, and at the end of 1 year, potentially will be at say $100,000 of annual recurring revenue, right? That's the other thing which is important. The third thing is, again, when you start talking to investors, and investors, again, will take their own time in coming to a decision, be in touch with them, keep sharing updates with them, right? We have invested in companies where we met them, say, 12 months back. We didn't invest at that point for whatever reasons, but they had stayed in touch with them, sharing monthly, quarterly updates, and we ended up investing 13 to 14 months down the line, right? So that is also important. If you're not able to raise, don't get disheartened. And the fourth and the final thing is, when you're looking to raise funds, try to get feedback from investors on what you can do better, and don't take that feedback in a negative way. I mean, listen to everything, and then use your own mind and brain to act on certain things that you feel would be relevant, right? So taking feedback is equally important.
Yeah.
Saurabh, sir, what would be your...
Yeah. No, I think I completely agree. I think VCs are also a way to gather feedback and kind of build rapport as well. I think broadly for an early stage founder, given you asked this question that if they are going about raising capital, some do's and don'ts, at least from my side. I think one of the biggest mistake I see from founders is, particularly when they are kind of a single founder, they'll end up spending 50% of their time raising capital, and that could be disastrous, right? That means that they are losing their focus on from the operations and kind of spending a lot of time in talking to VCs, which start kind of badly reflecting on their performance, and it could have a spiraling impact on their on their fundraise efforts, because they are not performing, and the VC sees that, hey, there is no traction, and they kind of decline on this, right? So that is one thing. Second piece is that the reality of fundraising is that, and again, it goes back to what we see on newspapers is not always what goes, the hard work that founders put in to raise capital. The reality is that these founders would have probably knocked 100, 200, 300 investors to raise that capital in, right? So be willing to talk to so many VCs and be willing to take reject as a answer, because that is going to happen in most of the cases. In most of the cases, VCs are going to reject you, particularly when you are early in the journey. And be willing to not get bogged down by that, because that's the nature of the industry is. The great thing about fundraising as a process is that you don't need all the VCs to say yes. You need one VC to say yes, and you are done, right? And so be willing to go through that grind of talking to so many VCs early in the journey. The great thing is that we in India, we have such a vibrant ecosystem, particularly in early stage. There are so many active angel platforms, micro VC funds that are out there, alumni networks who are actively investing, incubators, accelerators, they themselves are investing. I think India is at its best when it comes to at least the capital side of it, but also the support side of it. I think if you know, but particularly when you are a first-time founder and you are not plugged into this kind of investor ecosystem, you don't have a network, try to get yourself associated with a high-quality incubator, because that way what you would end up doing is not only the incubator would provide far more support to you, but they will give you access to a lot of VCs, because VCs come to those incubators for speaking sessions. They have their own network. They will get you connected, because that way you will save time. I think whatever happens, don't lose focus on the business that you are running. Don't get easily distracted by raising and spending a lot of money. In fact, I would say that because of the competitiveness in the VC industry today, VCs themselves are spending a lot of time in finding those hidden gems. So if you're doing something amazing, VCs would find some or other way to reach out to you rather than you reaching out to you. So I think keep on doing and keep on building business. Be very customer centric, and money would actually follow.
Right. Thank you, sir, for that brilliant piece of advice. Also a small advice on if you could just share a small advice to people who are wanting to explore into the VC side of the table. So what would be your advice to students who want to explore venture capital firms, sir?
Yeah, I think there are two, three things, and maybe Gaurav could also share his own perspective, because he has also kind of started with his own entrepreneurial journey. I think there are two paths that I see, actually two or three paths, right? One is that people starting with investment banking consulting as an industry, they come with a very strong analytical mindset, problem solving mindset to the table, and these people come and join kind of IB or venture capital as an industry. So that is one way to build a career in that direction. The other way to is actually kind of work with startups, or kind of some or other way get exposed to nuances of building a startup. That is also very, very valuable, because you are going to work with the startups, and you are going to not only bring a lot of operational insights as you work with the startups, but the empathy that is required to work with the early stage startups, because that is something that founders also very value, right? So that is another way to kind of get into venture capital as an industry. A lot of people, and I know few kind of really good professionals, what they've done is that they actually ask VCs to give them some internship, even if it's unpaid internship. They actually go and find a way to work with VCs to really understand what the VC industry is all about. I think one of the things which I've seen people who have excelled is they read a lot, because there is already so much out there. I think being updated on what's happening in the VC industry, how VC industry function, what of that information is very much out there. So as you approach a VC fund for a potential engagement to join them, I think having those understanding of the space would really help. Because what happens is that VC as a business is a very small business. It's not, they will not hire hundreds of people, right? They would hire very, very select people. And VCs are also very busy, so they are not looking for people who join them, and VCs hope that okay, they will spend a lot of time in coaching those people. That time VCs don't have. They are looking for people who can come in and immediately add value to the table, because it's a very small team, and every individual is an independent contributor who brings significant value to the table. So I think if you are interested in joining a VC, I think either build a path by either through IB consulting track, or a kind of an entrepreneurship or a startup exposure kind of track, but otherwise showcase strong hustling capabilities, where you can showcase that you can create immediate value to the table.
Right. Thank you, sir, for that advice. Gaurav, sir, what would be your advice for students trying to explore VC space?
So I think Saurabh beautifully covered all of that, right? Just one thing I would like to add is, before getting into VC or any investing career early, right? Try to spend some time in an operating role in a startup or in a tech product company, right? So that will give you the operational know-how of how a company operates, what is working, what doesn't work, how do you validate assumptions and things like that. And the second and the more important thing is it also gives you empathy, how to look at a founder, how to look at a team, how to evaluate a team, right? Because when you're looking as an investor, you expect everything to work smoothly, right? But when you're on the other side operating and executing things, it's not that smooth, right? So you'll develop that empathy that whatever, VCs may expect things to work very smoothly and have a smooth sailing. It is not that easy on the other side. And that you can only have that empathy if you have been on the other side, right? Or if you've worked long in the investing career to know that how businesses are built, right? So that way that's the only piece of advice that I'd like to give. Get into an operating role, get an internship or get a full-time job, whatever works for you. Get into that before jumping into the VC or investing role as a full-time career, right? The other thing is, of course, if you're in third and fourth year, do apply for internships to VCs. VCs would be happy to take you as an intern, right? That'll give you an idea into how VCs work and how VCs operate, and also give you a sense whether that is something that you'd like to do in the long run.
Right. Thank you so much, sir. As we conclude the session, I'd just like to know if you could tell our audience how they can reach out to you. So starting with Gaurav, sir, how do founders typically reach out to you?
So you can reach out to me over email. Our email ID is pretty straightforward. First name, which is Gaurav, Gaurav, @prime, PRIMEVP.in. So our fund's name is Prime Venture Partners. My email ID is Gaurav @primevp.in. That's the best way to reach out. Again, the other thing I just want to point out, whether you're reaching out to me or any other VC, it always helps if you come via reference, somebody that knows or somebody that we know, right? Because people get a lot of inbound emails, LinkedIn emails, messages, etc., right? So to prioritize that, you always go to and talk to people who have come via referral. So if you have somebody in the known network, that always helps. If not, you can directly write, and of course, people do reply.
Thank you, sir. Saurabh, sir, if you could share how people could reach out to you.
Yeah. In general, I'm very active on LinkedIn. I have recently, last few months, I do write on LinkedIn as well. So connect me on LinkedIn. That's one way to get connected. On email, if anyone wants to write to me, it is Saurabh @Pentathlon.VC. So you can get me connected on email. But LinkedIn is the best way to connect with me.
Right. Thank you, sir. Thank you so much for this wonderful session. It was extremely insightful, extremely interesting, and I hope the audience had a good time. I would, on behalf of Team E-Summit, I would like to thank Gaurav sir and Saurabh sir for taking out their time from such a busy schedule. I'm sure you guys are extremely busy, and I'm really, really grateful that you could be with us today. Thank you so much for joining in.
No, thanks for inviting us. I thoroughly enjoyed it. Really appreciate it.
Thank you, sir.
Thanks a lot.
Thanks, Gaurav. Thanks. Good sharing the panel with me.
Yeah, same here, Saurabh. Okay, take care. Bye.
Thank you so much. Have a great day.